Here are two women, same town, same kind of marriage, 40 years, careful with money, a comfortable retirement. Both of their husbands passed away last year. And here's the part that makes no sense at first. Their incomes barely changed. They each kept the bigger Social Security check, the same pension, the same savings. But one of them just got a tax bill thousands of dollars higher than the other for the exact same income. Not because she did anything wrong, because of a quiet rule almost nobody warns you about, a rule that punishes you the year after you lose your spouse. It even has a name in financial circles, the widow's penalty. And the cruel part is that by the time it hits, it's usually too late to fix. The window to protect yourself is before, while you're both still here. So give me the next 20 minutes, because I'm going to show you exactly how this trap works, 4 moving parts, and the handful of completely legal moves that spared the second woman the bill the first one got. One of these two stories is avoidable. Let me show you which. Let's start with the story most families live, because it's the one nobody sees coming. Meet Margaret and Jim, married 41 years. Jim handled the money, pension, a couple of IRAs, both their Social Security checks landing like clockwork. Together they had a comfortable retirement income, and for years they filed their taxes the way most married couples do, jointly. Married filing jointly. Hold on to those 3 words, because they're the hinge this entire video turns on. When you file jointly, the tax system gives a married couple a wide, roomy set of rules. Big standard deduction, wide tax brackets, generous thresholds before things get taxed. It's built for 2. Then last spring, Jim passed away. And Margaret, grieving, leaning on her kids, did what you'd do. She kept living her life. The pension survivor benefit kept coming. Her Social Security kept coming. The IRAs were still there. On paper, her money looked almost the same. She had no idea that a clock had just started ticking on her taxes. Fast forward to the next tax season, the first full year as a widow. Margaret sits down with her tax preparer, and the number at the bottom of the return is thousands of dollars higher than the year before. She's stunned. She says the thing everyone says, but my income went down. I lost Jim's smaller Social Security check. How is my tax bill up? And that question, that exact reasonable, baffled question, is the heart of the widow's penalty. Because here's the truth. It was never really about how much income she had. It was about which rulebook the government now uses to tax it. The year Jim died, Margaret could still file jointly one last time. But this year, the first full year alone, with no dependent children at home, she files as a single person. Same house, same income more or less. Brand new, much harsher rulebook. Let me show you the 4 ways that switch quietly costs her, because they all hit the same return at the same time, and they stack. So why does losing a spouse change your rulebook? It comes down to one thing, your filing status. While Jim was alive, they were married filing jointly. The year he died, the IRS lets the survivor file jointly one final time. A small mercy. There's also a special status called qualifying surviving spouse that can extend those married-style rules for up to 2 more years. But, and this matters, it's only for people with a dependent child still living at home. For most retired couples, the kids are grown and gone, so that lifeline doesn't apply. Which means the very next year, Margaret is simply single in the eyes of the tax code. Now think about what that word single was designed for. A young person with one income, one life. The single rulebook is narrower in every direction, and we're about to apply that narrow rulebook to a retirement income that 2 people built. That mismatch, wide income, narrow rules, is exactly where the penalty lives. 4 traps come out of it. Here's the first. Here's the first hit. Her tax brackets get cut roughly in half. Here's what that means in plain terms. The tax system works in tiers. Your first chunk of income is taxed at a low rate, the next chunk a little higher, and so on up the ladder. For a married couple, those tiers are wide. For a single person, in the middle of the income range, those same tiers start at about half the income. Let me give you the real 2026 numbers so you see it. For a married couple, the 22% tax bracket doesn't begin until just over $100,000 of taxable income. For a single person, it begins at just over $50,000, half. The 24% bracket, couples, $211,000, single, $105,000, half again. So Margaret's income didn't move, but the ladder underneath it just got shorter. The same dollars that sat comfortably in a low bracket as a couple now spill over into a higher one as a single filer. She's paying a higher rate on income she always had. Nothing changed but the word on the top of her tax form. Now the second hit lands right on top of the first one. And remember, this is all happening to Margaret on a single tax return in a single year. It's the standard deduction, the slice of income that's tax-free before anything gets taxed at all. As a single filer, it nearly cuts in half, and a widow loses some bonuses on top. Stay with me, because this one's bigger than it sounds. In 2026, a married couple's standard deduction is about $32,000. A single person's is about $16,000. So right off the top, Margaret loses roughly $16,000 of tax-free room. But it doesn't stop there. The tax code gives people 65 and older an extra deduction on top. A couple gets it for each spouse. Alone, Margaret gets just her own. And there's a newer one too, a special senior deduction worth $6,000 per qualifying older person in place through 2028. A couple where both qualify gets $12,000. Margaret, alone, gets $6,000. So added up, she loses half the base deduction, she loses Jim's age 65 bonus, and she loses Jim's $6,000 senior deduction. More of her income is now exposed to tax before we even get to the brackets we just talked about. Two traps, same return, stacking on top of each other. The third hit is the one that stings the most, and I want you to feel why, not just hear the rule. Because this one reaches right into the Social Security check itself. Margaret spent a lifetime paying into Social Security with Jim, and now, in the worst year of her life, the system quietly decides to tax more of it. Here's how that happens. Whether your Social Security gets taxed depends on a number the IRS calls your combined income. Cross one threshold, and up to half your benefit becomes taxable. Cross a higher one, and up to 85% of it does. And here's the kicker that makes this a widow's penalty trap. Those thresholds are lower for a single person, and they have never, ever been adjusted for inflation. They're frozen in the law. For a married couple, the 85% level kicks in at $44,000 of combined income. For a single person, $34,000. The 50% level, $32,000 for couples, just $25,000 single. So when Margaret becomes single, the line she has to stay under to protect her Social Security from tax drops by $10,000, and her income didn't drop nearly that much. The result? A bigger chunk of her Social Security check is now taxable than was taxable a year ago. Same check, same Margaret. The rulebook moved the goalposts closer. And there's one more, and this one comes for her Medicare. It's called IRMAA, a surcharge added to your Medicare Part B and Part D premiums once your income climbs above a certain line. And you already know the pattern by now, because it's the same trick. The income line for a single person is half the line for a married couple. In 2026, a couple doesn't hit that first surcharge until their income is over $218,000. A single person? Over $109,000, exactly half. So picture a survivor whose income stays high, maybe big required withdrawals from a traditional IRA, a healthy pension. As a couple, they sailed under the line, no surcharge. The day she files single, that same income can shove her over it, and now she's paying an extra premium on top of her regular Medicare every single month. It can run from around $80 a month at the first tier up into the hundreds at the higher ones. Now, these exact dollar figures shift a little every year, so always check the current bracket, but the structure doesn't change. The survivor's line is half the couple's, so the same income that was fine as two people can trigger a Medicare surcharge as one. Now, step back and look at all four traps together, because individually, none of them sounds catastrophic, and that's exactly why people miss it. It's the stacking that does the damage. The very same year, on the very same tax return, her brackets compressed, her deductions shrank, more of her Social Security became taxable, and her Medicare surcharge appeared. Each one pushes in the same direction. Each one feeds the next. More taxable income pushes her combined income up, which taxes more of her Social Security, which can nudge her over the Medicare line. They don't add up, they multiply. That's why Margaret's bill jumped thousands, not hundreds, on an income that barely moved. And I've seen this blindside families who did everything else right. They saved, they planned, and still nobody ever warned them about this part. The widow's penalty isn't one big rule you can see coming. It's four quiet ones that all arrive in the same envelope, the year you're least equipped to deal with paperwork. So when Margaret asked, "How is my tax bill up when my income went down?" Now you can answer her. It was never really about how much money she had. The rulebook underneath her changed, in four places at once, in the 1 year she was least able to deal with it. And let's sit with the cruelest detail for a second, because it's the part that feels so unfair. When a spouse dies, you'd think income falls a lot, and the tax break should follow, but it usually doesn't fall much at all. Here's why. When one spouse passes, Social Security doesn't pay both checks anymore. The survivor keeps the higher of the two and loses the lower. So if Jim's check was smaller, Margaret loses the small one and keeps the big one. The pension, if it had a survivor benefit, keeps paying. The IRAs are still there, and the required withdrawals from them keep coming every year no matter what. So Margaret's income might drop by, say, 15 or 20%, losing that one smaller check, while her tax rules got cut nearly in half. Income down a little, tax rules down a lot. That gap, right there, is the entire penalty. The system treats her like a single young earner while she's living on the retirement two people spent a lifetime building. Understand that mismatch, and you understand why this is worth planning for years ahead of time. Now, I mentioned a lifeline earlier. Let me be straight about it so nobody gets their hopes up wrongly. It's called qualifying surviving spouse status. If you have a dependent child living at home, you can keep filing under the married, wider rules for up to 2 years after the year your spouse died. That's a real, valuable break. But here's the honest part. The vast majority of the people watching this are retired with grown children. No dependent kids at home means no qualifying surviving spouse status. You go straight to single the year after death. I'd rather tell you the truth than sell you a loophole you can't use. For most retirees, this lifeline isn't there, which is exactly why the real protection has to happen earlier, before either spouse passes, while you're still a couple with that wide rulebook to work inside. So let me switch stories now. Let me show you the second woman, the one who got the same income and a far smaller bill, and exactly what she and her husband did. Meet Eleanor and Frank. On paper, almost a carbon copy of Margaret and Jim. 40 years married, a pension, 2 IRAs, 2 Social Security checks, the same comfortable income. But Frank had heard about the widow's penalty a few years before he passed, and instead of ignoring it, he and Eleanor sat down with a tax professional and did something simple but powerful. They used the years they had together, the years with the wide married rulebook, to quietly get ahead of the trap. They didn't do anything exotic, nothing risky, nothing the IRS frowns on. They just understood that the wide brackets and low thresholds of a married couple are a limited time resource, and they spent that resource on purpose while they still had it. So when Frank passed, Eleanor still became a single filer. That part's unavoidable, but there was simply far less left to be punished. Her tax bill barely moved. Here's the playbook they used. 4 fixes, matching the 4 traps. Fix number 1, and it's the big one. Roth conversions during the married years. Here's the idea in plain English. Money in a traditional IRA has never been taxed, and one day it has to be, either by you in withdrawals or by your survivor at those harsh single rates. A Roth conversion means you deliberately move some of that traditional IRA money into a Roth account and pay the tax on it now, on purpose, while you're a married couple sitting in those wide, low brackets. Yes, you pay tax in the year you convert, but you're choosing to pay it at the couple's lower rate today instead of leaving it for your widow or widower to pay at the single rate later. And once it's in the Roth, it grows tax-free, comes out tax-free, and, this is key, it doesn't have required withdrawals hanging over it. So every dollar Frank converted while he was alive was a dollar Eleanor would never have to pull out and get taxed on as a single filer. It shrank the very thing the penalty feeds on. This is the move. If you take one thing from this video, it's this conversation with a professional while you're both still here. Fix number 2 works hand in hand with the first. Fill up your low bracket on purpose in your good years. Think of each tax bracket as a bucket. As a married couple, those buckets are big. A lot of retired couples have a few years, especially early retirement, before required withdrawals, and sometimes before Social Security has fully ramped up, where their income sits low in the brackets, with lots of empty room at the cheap rates. Most people leave that room empty. The savvy move is to deliberately fill it, usually with a Roth conversion like we just discussed, pulling income forward into those low-cost buckets while they're wide open and shared between 2 people. Because every bucket you leave empty as a couple is a bucket your survivor will have to fill later, alone, in a smaller bucket, at a higher rate. Eleanor and Frank looked at their income each year, saw how much room was left before the next bracket, and topped it up intentionally. It's not about paying more tax overall. It's about paying it at the couple's rate instead of the widow's rate. Timing, not magic. Fix number 3 is a quieter tool, but it directly fights traps 3 and 4, the Social Security and Medicare income lines. It's called a Qualified Charitable Distribution, a QCD. If you're 70 and a half or older and you give to charity anyway, you can send money straight from your IRA to the charity. Here's why that's clever. That money counts toward your required withdrawal for the year, but it never shows up in your income. And remember, it's your income number that decides how much of your Social Security gets taxed and whether you cross that Medicare surcharge line. So a QCD lets you satisfy the required withdrawal without pushing your income up into the danger zones. For a survivor especially, living with those cut-in-half single thresholds, keeping income off the books like this can be the difference between staying under a line and tripping over it. You're giving to causes you already care about and managing your tax exposure at the same time. Eleanor used these every year. It's the kind of small, legal, repeatable move that adds up. And fix number 4 is for the survivor themselves in that first hard year. because there are still moves to make even after the loss. Remember, the year your spouse dies, you can usually still file jointly one final time. That final joint year is a gift. It's your last year inside the wide rulebook, and it's often the smartest year to do one more Roth conversion or to realize income at the lower married rate before the single rules take over. If you qualify for that 2-year extended status because of a dependent child, use those years just as deliberately. And in every case, this is the moment to sit down with a tax professional, not to wing it. The survivor who plans that first year well can soften the landing a lot. The one who doesn't notice the rulebook changed, like Margaret, gets the full bill. Same loss, very different outcome, and the difference is just knowing the calendar you're now on. So let's make this practical. Who are you in this story, and what do you do Monday morning? If you're a married couple, both of you still here, you are in the golden window, and most people don't realize it's a window at all. This is the time to have the Roth conversion conversation, to look at how much low bracket room you're leaving empty each year, to set up QCDs if you're giving anyway. You have the wide rulebook right now. The whole game is using it before you lose it. Don't wait for a diagnosis or a scare to start. The earlier you begin converting, the more years of low-rate room you get to use. And if you're already a survivor watching this, it is not too late. It's just a different job. Your focus is managing income against those single thresholds, careful withdrawals, QCDs, watching the Medicare line, and making the most of any remaining joint or extended status year. Either way, the move is the same in spirit. See the rulebook you're on and plan around it on purpose instead of getting surprised by it. Now let me be very clear about something, because this is your money and your family. Everything in this video is educational, not personal tax advice, because I don't know your numbers and the details are everything here. What I've laid out is the mechanism, the how and the why of the widow's penalty, and the kinds of legal moves that soften it. But the right amount to convert, the right year to do it, whether a Roth conversion even makes sense for your specific picture, that depends on your income, your health, the state you live in, and how it taxes retirement money. Whether you're still working part-time, what your required withdrawals look like, your whole situation. And here's the thing people don't realize. A Roth conversion done carelessly can itself backfire. Convert too much in 1 year, and you can push your own income over the very Social Security and Medicare lines we just talked about, or bump yourself into a higher bracket for no good reason. I've seen people try to do this on their own and overdo it. Too much at once and it works against you. That's why you want someone running the actual numbers. So this is not a do-it-yourself-tonight project, and it's not something to copy from a stranger on the internet, including me. This is exactly the conversation to bring to a qualified tax professional or a financial advisor, ideally a fee-only one who actually does retirement tax planning and can run your numbers year by year. They can model it, how much to convert, in which years, to keep you under the lines that matter. What I want you to walk away with isn't a number, it's the awareness, so that when you sit down with that professional, you know to ask the one question most couples never think to ask until it's too late. What happens to our taxes when one of us is gone? And what can we do now, together, while we're both still here, to protect whoever's left? That single question, asked 5 years early, is worth more than this entire video. Most people ask it 5 years too late. Let me tie it all together, because if you remember the shape of this, you'll remember the whole thing. The widow's penalty is 4 traps that all hit the year a surviving spouse files single. 1. The tax brackets compress. Single tiers start at about half a couple's. 2. The standard deduction nearly halves, and you lose the senior bonuses your spouse carried. 3. More of your Social Security becomes taxable because the single thresholds are lower and frozen in law. 4. Your Medicare can pick up an income surcharge because that line too is half. And against those 4 traps, 4 fixes, all done best while you're still a couple. Roth conversions at the lower married rate, deliberately filling your low brackets, qualified charitable distributions to manage your income lines, and using that final joint tax year with intention. Income barely drops, the rules drop a lot, so you plan for the rules. Margaret didn't know and got the bill. Eleanor knew and didn't. And the only real difference between them was that Eleanor and her husband sat down and talked about it years before they ever needed to. Most couples never think about this until one spouse is already gone, and by then, the easy moves are off the table. If this opened your eyes, do the one thing that actually helps. Bring it to the people you love. Forward this to your spouse. Sit down together this week and put the widow's penalty on the list for your next talk with a tax professional. That single conversation, while you're both still here, is the whole point of everything I just showed you. And before you go, one more piece of your retirement that quietly costs people real money: your Social Security earnings record. There are mistakes hiding in millions of these records. A year of earnings missing, a number entered wrong, and every error can shrink your check for the rest of your life. Most people never check. In the next video, I'll show you exactly how to pull yours up and spot the errors in about 2 minutes. So subscribe, and I'll see you there. Because the people who plan ahead are the ones who keep what they earned. Take care of each other.